High-tech growth investing is the latest advancement in traditional growth investing methods. In this video, we'll show you the downsides of traditional growth investing and why high-tech growth investing is a superior approach. Let's take a look at traditional growth investing. Here's the traditional definition of growth investing. According to Investopedia, growth investing is a strategy that focuses on capital appreciation and targets companies that are expected to grow faster than their peers. Now here's the high-tech growth investing definition. High-tech growth investing is a strategy that focuses on capital appreciation and targets companies that participate in the highest growth markets. See the difference. High-tech growth investing isn't about companies that are the fastest growing in their markets, but about companies in the fastest growing markets, period. Why invest in the fastest growing grocery store chain when you should be investing in the fastest growing artificial intelligence company? Now, let's look at traditional growth investing stock screening methods. The first is selecting companies with strong historical earnings growth. Companies should show a track record of strong earnings growth, earnings per share, over the previous 5 to 10 years. However, there are 3 significant downsides to this method. 1. Past growth is not predictive of future growth. Historical earnings growth is not always a reliable indicator of future performance, as changing market conditions, competition, and business cycles can quickly undermine a previously strong growth trend. 2. High volatility and estimation error. Earnings growth often fluctuates significantly, especially over longer time horizons. The noise in reported earnings and limited historical data points can lead to estimation errors, making it risky to forecast future growth solely on past results. 3. Susceptibility to accounting manipulation. Earnings figures can be heavily influenced by accounting decisions and non-cash adjustments, such as deferred revenue, making historical earnings growth potentially misleading compared to more persistent metrics like revenue growth. The second stock screening method for picking growth stocks is strong forward earnings growth. These forward earnings are based on analysts' estimates for future earnings. Again, there are a few downsides to this method. 1. Reliance on uncertain estimates. Forward earnings growth depends on forecasts and analyst estimates, which are inherently uncertain and can be affected by optimistic assumptions, bias, or even intentional misrepresentation by companies or analysts. 2. Short-term focus can ignore long-term cycles. Forward growth metrics often project only 12 months or a single earnings cycle ahead, potentially missing longer-term strengths, weaknesses, industry cycles, or structural changes that affect a company's true growth prospects. The third stock screening method is using strong profit margins measurements. A company's pre-tax profit margin is calculated by deducting all expenses from sales, except taxes, and dividing by sales. The 2 downsides to this method are the following: ignoring growth rate trade-offs. High profit margins often signal low reinvestment in expansion, research, or marketing, meaning companies may sacrifice future growth to maximize short-term profitability. Potential for unsustainable margins. Current high margins can result from temporary factors such as tax breaks, cost-cutting, or favorable regulations. If these dynamics reverse, margins can deteriorate quickly, impacting valuation and growth expectations. The last stock screening method is strong return on equity, ROE measurements. A company's return on equity, ROE, measures its profitability by showing how much profit it generates with the money shareholders have invested. There are 2 downsides to this method. 1. ROE can be artificially inflated by high debt. A company can boost its ROE by increasing leverage, which lowers shareholders' equity and raises ROE, even if true operational efficiency or profitability has not improved. This increases financial risk and may mislead investors about the company's true quality. 2. ROE can be distorted by share buybacks and low equity. Share repurchases reduce the equity base, mechanically increasing ROE even when net income is stable. Similarly, companies with chronically low or negative equity can report unusually high or meaningless ROE figures. As you may have noticed, the main problem of traditional growth investing is that past performance is not predictive of future growth. Using historical financial measurements does not mean that growth will continue in the next 6 months or next year. Now, let's look at the high-tech growth investing method. This method is not dependent on a company's historical financial performance but relies on market analysis of over 24,000 global markets. Of these 24,000 global markets, 1,600 are forecast to grow by more than 30% annually. 2,800 markets are forecast to grow by over 20% annually. This market analysis is based on executive interviews, trade journals, and market research surveys. This is the kind of market analysis that fund managers, investment banks, and angel investors pay thousands of dollars to access. For example, The global deep learning chipset market is forecast to grow by 36% from 2025 to 2026. Now that we've identified the high-tech growth markets we want to target, we can identify the private and public companies operating in those markets. We can use a public company stock screener like Yahoo Finance to pick those companies that are undervalued compared to their competitors or that have a strong profit history. Or we can buy shares in private companies in the market with highve.com or forgeglobal.com. Or we can invest in private companies on the market through crowdfunding platforms like wefunder.com or startingine.com. For rankings of global markets with 30% and above growth, please visit www.hightechgrowthinvesting.com. And subscribe to this channel. We'll be highlighting winning high-tech growth markets weekly so that you can maximize your growth investing strategies.